From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those who champion market growth and anchor the nation's economy, small businesses, and entrepreneurs.
Hey everyone, this is Mike Maxon and Brandon Gray for another episode of the Simple Numbers Profitability Playbook podcast. And, day after Easter, it's April 21st. The Pope passed away today, so may he rest in peace. We hope everyone had a good Easter weekend. And by the time you're listening to this one, everyone, you'll have listened to the one before this, and you're going to really like the guy we had on. But Brandon, man, I didn't feel that smart during that. That guy was awesome, man. I got off that. I'm like, this guy is so above me. And, I went home and did some mental push-ups after that one
I
because
hear you. Yeah,
that guy was impressive.
great things. And we kind of summarize a little bit of the parallels of what he's talking about to simple numbers clients. Because most of the things that we were discussing on the podcast, we've been discussing those, the difference between growing and scaling, what we call that leveraging of expenses. We also talked a little bit about the competitive advantage that you have, and he talked about that as a moat around your business, some of those kind of things. And so it was very good. I mean, you definitely got to check that out. If for some reason that you've missed it, one of the better podcasts that we've had. And so
For sure.
Yeah.
Well, awesome. So today we're gonna sort of hit all over the place. We're gonna hit our 100 company model a little bit, give you an update there. We're gonna talk about what's going on in the PE world. We're going to talk about what sort of rhythm you should have for reviewing your financials, and then some revenue recognition. So we're all
over it. Yeah, this is a good one.
I do like that a little bit. Sometimes to mix it up rather than just one topic. But
yeah, definitely.
Well, all right. So 100 company model, real quick before we get started, man. What's interesting about this is we're going to talk about it, but it'll be interesting to see when these next couple updates come out, when we start to get the tariff stuff going on.
Right.
That's working its way through it. But why don't you kick us off?
Yeah. So a few highlights. We've talked for some time with our clients, really since the end of last year, about what we kind of termed as an energy drink economy. And I think we've mentioned it a time or two here on the podcast as well, in that if you go back to middle to end of last year, you had the election finally resolved. And at the same time, you had some interest rate decline. And those two forces kind of freed up a lot of pinned up demand. And so we're kind of moving along. Like I said, it was an energy drink for the economy. You got everybody jacked up and rolling forward. And if you don't follow an energy drink up with substance, then you crash. And I wouldn't say that we've crashed, but I'm kind of putting a stake in the ground at the end of February, which we're about 6 weeks past that now, as we've looked at the data that has come in since that time. And as we've been having calls with our clients, we're seeing it slow down a little bit. The 100 company model is starting to reflect that. If you look at the short term kind of profitability, excuse me, those clients had a pop at the end of last year. It started to come up, peaked around December, January, February, and then into March, you've started to see a little bit of decline. Not massive. It's not like it just cratered. And then as we've been on calls, we've been hearing a little bit of a hesitation, you might say.
Soft.
Right. Yeah. I mean, when we had calls in January, it was, hey, people are pulling the trigger on deals. Pipelines look really good. We feel great about 2025. And some of that's just new year. Everybody's excited, right? But now we're starting to hear, well, things are moving a little bit slower. They're not bad, but we're not moving as quickly as we originally had. Deals are taking a little bit longer to close. There seems to be some more uncertainty around larger spends and long-term spends. So things like that. It's somewhat reminiscent of what we were hearing in 23. And so that being said, the obvious thing is what's taking place with tariffs. We've discussed that several times on the podcast, and just about every call of clients, it comes up. It's definitely putting a little bit of a damper on things, just the uncertainty. And I think we said an episode or two ago, one of the quotes that I really like that came from Micah Ledbetter, one of our consultants, is that the market likes bad news better than it does uncertainty. And so with that uncertainty in place, it's slowing things down just a little bit. One other observation. Go ahead, Mike.
Yeah, no, I was just going to say that one of the things that I noticed too is that we're running into that danger zone of a little bit of flattening growth, but we're not seeing the costs decline anywhere. And then with the tariffs coming in there, we're sort of running against, and what you get in that sort of economy with that is sort of a stagflating economy, stagflation that they call it, where we have this no growth but high cost environment, and we're running up against a lot of clients too that have sort of hit that price increase wall in many industries where they've sort of just, the consumer ain't buying as much anymore at any higher prices than what they already got. So I'm concerned about that.
So one thing that is reflective of that is we've seen direct LERs start to move down just a little bit. And it's been a long time since we've seen that. Most of that is due to a lot of businesses are operating on a skeleton team. And so if you continue to experience gross margin dollar erosion, there's no other direct labor to go reduce. I mean, you got to have a minimum number of people just to keep it rolling. And so we got a retail client, and you got to have somebody at the cash register. You got to have somebody on the floor. You can get it skinny to a level, and then it just hits that bare bone. And so as you see margin dollars decline, that labor efficiency comes down with it because there's no offset to be made there. So we're seeing a little bit of that. The other thing, and by the way, we go through this with our simple numbers consulting clients in detail. So, you're going to miss out on a little bit of that because obviously we're going to kind of keep a few things just for them that are part of our community model. But the other thing that we're backed into it every which way I can, Mike, and I keep coming back to 7% on that inflation number.
Yeah, that's where it is. It's not moving. I'm with you.
So, yeah, like we said, cost increases are difficult, but they're not impossible. Or, I'm sorry, price increases are difficult, but they're not impossible. I've got to have a really clear competitive advantage and make sure that's being communicated. And that's one thing I'm continuing to see folks kind of struggle with. If you keep kind of throwing out there, well, we're the best at customer service, good luck, because everybody is the best at customer service. You've got to have something that is really going to set you apart or quantify, with real data as to perhaps why you are the best there. So, what do you do with the data we just gave you? Well, it's very unclear and very foggy where everything is going to move. But the one move that we know we have to make is that we are continuing to be in a marketplace to where you have to go and steal the business. The overall market's not growing. I've got to take it from my competitor. And so you got to think tactically of how I'm going to go and play offense, make those moves. Once again, that clear competitive advantage. The reason why that they should do business with you, I use the marketplace as my microphone to do so. And I just don't have any margin of error. If we've got a prospect, a lead, a customer, you name it, we've got to make sure we deliver a phenomenal experience, because we can't afford to have churn. We can't afford to miss out on the opportunity. We can't afford to go, well, we did our best, we just didn't close it. There's not a line of people behind them. So
I don't know about you, but I've seen an influx of several of my clients looking to hire more in the, that customer success position, that basically that person dedicated to keeping those accounts.
Yeah.
Really focusing on and really establishing more of a relationship, because all of you out there know that, hey, if you have a good relationship with someone, you take care of them, to push price increases through, to push things like that are a lot better. To work with them on labor pieces. Those are all things that having that person in that position or dedicating someone to taking care of the clients a little bit better. And I've had people at times where, they've struggled and they're like, hey, listen, I got to learn, I got to stop the churn in my business, keep customers longer. Cause you got a lot of people in industries right now, coming through and undercutting you on price, trying to do something to get there. And so it's a street fight out there. And so you got to look at ways to how do you combat that?
So two things there. One is that look at the return on investment with that hire. What do I have to reduce churn by to get a 50% return on that person's salary, which means I get their salary back and make 50% of that salary in the form of profit. So I want to have clear expectation there of what it's going to take to move that needle. Secondly, I've got to have a really good game plan as to what they're going to do and what I'm going to hold them accountable to. So if you just roll out there and throw out, we want you to take care of our clients or customers, or we want you to reduce churn. We want you to upsell our existing clients or customers, potentially. You got to quantify it. How much? Get very tangible around that. What does success look like for that role? Because for many organizations, that's a new role if they don't have it. And some that have it, they don't have the clear expectations either. And so it's one of those things to where you think it may be working, but you're not really tracking it to make sure. Or if you are to start it, the clock's ticking on that return on investment, and you got to make sure that you're looking at the right data that tells you for sure that you're getting a return on it. So keep grinding. It's not going to get easier. I guess that's the high level there.
Fight it out.
Yeah, let's talk a little bit about this Wall Street Journal article. I think it was over the weekend about private equity. We've talked about private equity a few times. It is a popular topic. So kind of some of the highlights around that and give you our take on what we're seeing with our client base as it relates to it as well.
I am like word overload, right? I don't know how much I've heard in my life. PE, AI, COVID, keto, Beyond Meat. Yeah, PE was just rocking in there with that stuff, right? So it's always fun to talk about PE. But what I like, man, is that they just talk about the perfect storm of what's going on. And I just wrote down real quick what that perfect storm is recession fears, tariffs, and interest rates. And it's locking up PE money right now. And so I don't know how much you read in that, Brandon, but firms are sitting on a record 29,000 companies worth 3.6 trillion, where 50% are owned for 5 years or more. And the amount of money firms have on hand, or what people like to call dry powder, relative to the amount they have locked up in unsold companies, is at a record low. So deals aren't flowing right now.
Yeah, it's kind of a game of hot potato. You don't want to get caught holding it, or musical chairs, whatever you want to call it. And PE has an important role in the economy. By no means am I opposed to it or dislike it necessarily, but what you're seeing right now is that they're in a position that they're typically not used to having to fight from, which is holding companies. They're really good at spotting companies, buying them, perhaps putting some economies of scale into place, consolidating similar companies together, owning them for a couple of years, and then selling them to the next group, who then can wash, rinse, and repeat, and it gets larger and larger as you move along. That's the typical play that's made. They're normally not structured, and I say normally because there are funds out there that play a different game. So not every PE fund is the same. Some do have a buy and hold strategy, but that's not the norm in the industry there. And right now, just like the article stated, they're faced with a lot of buy and hold. You go back in time and maybe the business was acquired in 2021. Okay, well, we're right at that 5-year anniversary to where you typically would be looking to perhaps divest of that company, move on to the next thing, keep the capital flowing. And the last 2 years haven't looked that great in terms of earnings. There's a lot of uncertainty moving forward. And so the buyers are very, very cautious. And you're kind of faced with running a play of running a profitable company that perhaps you haven't dealt with as much in the past.
Mm-hmm.
And then on the same kind of vein, the normal play is, like I said, kind of flip. I need capital coming in to make that flip. And you've heard us talk on here, and the data was out there for years about the amount of dry powder that these companies were sitting on. Well, they went through a lot of the dry powder. And now companies are looking at that next round of, I got to raise more capital. And folks are a little cautious, much more cautious than what it looked like earlier. I heard something interesting this past, or 2 weeks ago. I was from a building supply company, and they were talking about a luxury home that was being built in their market. And this is, one of those that's probably 10 to 15 times what a normal home would be. I mean, it's a nice place. And it was almost ready for the main house. It's one of those properties that has multiple homes on it, right? The main house to start the framing, and they paused, which is rather unusual. Spoke with the contractor. They said, yeah, the owner of the property's paused building temporarily. Come to find out, some of the hits that they've been taking in the stock market are influencing how quickly they wanted to move forward. Well, I'm not saying that the stock market is to blame by any means as to the amount of capital pouring into PE, but it's likely a factor. If you've got money in an investment portfolio that you've looked at and you're kind of going, hey, I think I'm going to move it over into some PE types of funds or what have you, some venture funds, and all those investments are down, you may not be wanting to exit right now. I'm not saying you should or shouldn't, because I don't give investment advice, but I know psychologically a lot of times people hold on to investments thinking they need to come back up. And so I think that's also perhaps playing a role. So some bumps in the road. That being said, we have several clients right now that have LOIs. And so there is a segment of the market that's still moving, but I think this is just another reflection of the uncertainty that's taking place out there.
Yeah, absolutely. Well, awesome. Good one. Let's move to the next one. I like this one. I like them all, but I like this one because it just, when we're on the phone with our clients, it's financial review rhythm. And I mean, I think we obviously do a lot of that with our clients. We're sort of their finance meeting and things like that. But what brought you, what made that come to your mind today?
Yeah, I'll give you the overview. Then, Mike, I want you to kind of list what you recommend there. So I've had a couple of calls in the past few weeks to where this topic's come up, and it's weird. Things. It might just be you're looking for it once you hear it on a call with clients, but things many times we'll hear a theme. That may last 3 or 4 weeks, to where it seems like every other call you hop on with a client, they're talking about something, and they all have them in common. And this financial review is one of those that I've heard several times, to where how frequently do we need to be looking at data? What do we need to be looking at? What actions do we need to be taking around it, and what have you? And so, obviously, with a lot of our clients that are on a monthly consulting rhythm, we're doing that every month with them. But there's a lot of entrepreneurs out there that maybe aren't looking at the data in a normal rhythm and in a timely manner. So, Mike, kind of what are your typical recommendations there?
Yeah, so the monthly one is always the best because usually you have the books closed. And so let me start off with the monthly, and then what I think, if you need something frequently, what I think after that. So every time you go into the finance meeting, and I'll go over what I go over with my clients, and I think it covers it, because this is what has to be talked about when you get in there. And this doesn't have to be 5 hours. We cover this stuff in an hour. You got to talk about your sales pipeline, where, these are things you have to know before you just go diving into numbers.
Right.
You have to know what your current sales pipeline is. You have to know any marketing initiatives that are coming up. You have to know about any expenses, whether it's a capital investment or whether it's, hey man, we got to, that insurance renewal comes up next month for 15,000 or whatever it is. Those have to be in there, and out of the ordinary expenses that, oh, hey, we didn't see it coming. That server we had is about to go. It's going to cost this. And the next thing is on your labor and the labor needs around it, because that's dollars spent, good or bad, what's going on the labor side. But then from there, you got to review your month. You got to review your numbers going over, hey, what happened on the month? What happened on the rolling quarter? And so how are we trending annually on a year-over-year basis on a rolling 12? And that usually will fit in nicely in your monthly meeting to go through that stuff, to come out of there going, hey, I know where we're at. And then obviously the most important thing is how that then relates to cash flow. So let's say you do that on a monthly basis, and then you tell me, well, like, hey, I don't, I just feel like I'm lost until that monthly meeting. Well, okay, well, sometimes depending on your business, it's very hard to get very accurate weekly data, right? Like that, sometimes there's just moving parts. You're getting stuff into the books, transactions are going in place. But what are those key things you can look at? So for example, we've always recommended, hey, our clients in small businesses seeing how much money is coming into the bank every day on a daily deposit report. Are they getting a 2-week cash flow projection of money that is potentially going to come in and out? Where is our AR balance? And so you'll see more of a bi-weekly type meeting that comes in, where weekly it's more of like check-in numbers of pulsing. Weekly might be a little bit bigger of a data set, and then monthly is your full review of that month and that that last quarter. So those are how I recommend that meeting really look. So start small on pulsing data and a quick check-in for the week, a little bit more robust on what's moved on a biweekly basis, and then a much more robust monthly meeting. And that should give you plenty of meat to see any potential issues arising. Thoughts on that, Brandon?
Yeah, I mean, at Simple Numbers, we live by the calendar, and we're advocates that everyone should, in some form or fashion, have that monthly financial review meeting. Go ahead and schedule it out for the next year. Schedule it out with all team members who are impacted, who need to be a part of that. It's a standing meeting. You know, it's going to be on such and such Tuesday, every second Tuesday or whatever it is at the same time, and know ahead of time what are the things each team member needs to be responsible for bringing. One thing I would add to that Mike mentioned is the forecasting component. So, you've got an idea of your pipeline. You've got an idea of any adds that you may have to the team, reductions to the team, expenses, anomalies, all those kind of things. You're looking at the current month and like we said, hopefully in context of our rolling 12 as well. And then what do the next couple months look like? Are we going to beat the same month from last year? Because if we do, the R12s continue to make progress. Or are there issues ahead? And for the companies that have been in a challenging financial position, we many times talk about this line in the sand of, hey, if it gets to this point, that's where the alarm should be going off, and you've got to follow through with a decision. Many times it's around a spend or around your team. And have those in place so that everybody's on the same page. We know when that happens, this is what we're going to do. We can go and attack from that standpoint. But like Mike said, hey, you're talking 15 minutes a week to do kind of just the review of where your cash flow is going. And by the way, your accounting team should prepare that. If you got questions on that, reach out to us. We can give them some guidance. And then at most an hour a month. So it's not a huge time commitment, but it really kind of enables you to go to battle every day, knowing where we're at and what the game plan is from a financial standpoint.
Yeah, absolutely. And we talked about it before, everyone. Just a reminder, remember, you have your financial numbers. Remember those key numbers we tell you to pulse on throughout the weeks that give you those leading indicators of, hey, if you're talking how many times the doorbell rings when someone walks through a door, and that you need to hit 100 a day and you need to hit 500 a week. Well, guess what? If you get to every Friday and it's 300, it's trouble. So pulse numbers, yeah. And it's pulse numbers that are leading up to that. Me and Brandon track a lot of things here and look at a lot of things. Most of the time when the month comes to an end, he and I know what's it gonna look like. And so that's what you want to get to. So when you get in there, you have it. So you're more focused on, hey, what's the current to then projected view going to begin to look like in the business? So you're not surprised by what has happened.
No surprises.
Cool. All right. Last one, man. Revenue recognition. This is always a pain point for some people.
Yeah. Well, the reason I threw that in is because many times in that financial review, you'll sit down and look at the data and you'll go, well, this doesn't look right. It either looks really, really good or it looks really, really bad. And you kind of get to looking at it and you go, wow, we had a ton of revenue this month, but I'm not seeing much in the cost for that revenue, the direct cost associated with it, or vice versa. Had a ton of direct costs, but where's the revenue? Well, especially in businesses that are less than 5 million. Now, I wouldn't say if you're above 5 million, you're exempt to this, because I've seen some really large clients who have an issue with this. But that being said, it's more common in companies that are under 5. What we would refer to, the accounting world refers to as revenue recognition, which basically says whenever I put the revenue onto my profit and loss statement, when I recognize it, I want at the same time to recognize any of the cost associated with generating that revenue. So let's say you're a wholesaler, for example, and you have a big order. It gets placed on the 27th of the month. You book all that revenue, but you didn't make the entry to either book the the goods that you are then buying to fulfill that, or to take it out of inventory. And some folks have a really good inventory management system and other folks don't. Or on the other side, perhaps you said, hey, tariffs are coming. I need to buy a lot of inventory. You're not putting it in your inventory in your balance sheet. Instead, you're booking it as a cost of good. Well, I might have bought a 3-month supply. So I've got 3 months of cost and 0 months of the revenue associated with it. And so when you look at that financial data, you kind of go, well, I can't tell you which way's up. And so at the least, you need a very basic process to make sure I get it within reason. I'm not looking for it to be perfect. I just need it to be ballpark, because I'm using this data. We call this management accounting. I'm using this data to manage the company, right? And so I told a client this last week. They said, hey, there's some tariffs coming. We're going to buy a 3-month supply of this product. And they don't have a way to easily manage their inventory. I said, okay, it's going to last 3 months. You buy it this month. Are you using any of this month? No. Okay. So I'm going to use it over the next 3 months afterward, take 1/3 of that expense the next 3 months. It's not going to be perfect, but it's going to be close to being able to then, when I sit down and do that financial review meeting, I'll at least have some idea of, where I'm moving at. The other thing is looking at the data on a rolling 12 basis can many times help level that out, but it's not perfect, because you may be making these bulk purchases or having these large revenue events without the corresponding cost at different times during the year. And so sometimes it can even get off there. So once again, a small adjustment. If your bookkeeping or accounting team has questions on that, we can put them in touch with some of our experts. But it is probably one of the things that I see that leads to just a massive distortion in profitability one way or the other, that prevents you from being able to make the best decisions.
Yeah. Excellent. Yeah, I have some of that too. And it definitely will skew things in the near term. And then especially if you don't pay attention to, when those pops are going to be from a cash flow perspective. So, hey, we just bought a boatload. We have money now. And it's like, well, in 3 months, 4 months, you're going to have to buy that again.
Yeah. And as you grow and get larger, it's only going to get more complicated, and it's only going to create more distortion if you don't correct the process now.
Yep. Yeah. Awesome. Well, sweet, man. We moved out pretty quickly.
Yeah. Good things.
Hey, real quick, man, I got a text. I'm not gonna say who, but I got a text. This was it Friday? Hold on, I can tell you it was. I'm gonna read it on here. It was funny too, because it was Thursday, and it hit you pretty good too. So I'll just read it out. It goes, hey man, just heading home from the airport, listening to your podcast, and I wanted to again tell you how great they are. I think I'm going to need you to come out here in September and do a 3-year financial plan in person with me and my partner and our president of our company. And we were also thinking about having Brandon come along too.
Man.
Oh man, so I had to do that. That was all for
Mike had one of his buddies send him that. He needed the ego stroke this morning.
Yeah, it was one of my former Army buddies. I was just like, hey man, listen, do this. I'm going to read it on the podcast. Totally. Awesome.
On that note, hey, we are here. If we say kind of piques the curiosity, and you want us to take a further look, let us know.
And I'll bring Brandon along.
Yeah, I'll tag along with Mike. So.
Awesome. Well, hey, man, great episode. Hope everyone enjoyed it, and we'll be back next week again.
Sounds great.
If you want to know more about driving sustainable profitability for your business, or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers Podcast. You can subscribe to Profitability Playbook on Apple Podcasts, Spotify, or wherever you prefer to listen to podcasts. If you liked what you heard today, please leave us a review. The views expressed on Profitability Playbook, the Simple Numbers Podcast, are those of the presenter and moderator and do not necessarily reflect the views of CRI Simple Numbers or the CRI family of companies. This podcast is intended for informational and educational purposes only and is not intended to replace professional advice received directly. Consult with your CRI Simple Numbers advisor or another trusted professional if you have questions about your specific situation.